G'day and welcome to the Morgans Edward Street Weekly Wrap for the 23rd of March. This will be the final week prior to the Easter period, so we wish you and your families a happy break. On to business, and equity markets this week have remained subdued, whilst our corporate department has kept us busy with a number of capital raisings. To tell you more, I'll pass you over to Matthew for further detail, but firstly, please note our comments are general in nature and please speak to your Edward Street advisor if you wish to know if any of the stock recommendations suit your personal needs and objectives. Matt.
Thanks, Cam. US stocks declined sharply last night as President Donald Trump announced tariffs on 50 billion of Chinese imports into the country, stoking fears of retaliation, ending markets into a spin. The Dow Jones Industrial Average dropped almost 3%, being the biggest drop in 6 weeks after the volatility index rose 28% to 22.8, and our local market is likely to be down around 100 points today. The tariffs, which are basically taxes on imports, come after an investigation by Trump administration into Chinese theft of US intellectual property. For instance, the country has forced businesses to move their patents to China or disclose their trade secrets to do business there. Trump announced 25% tariffs on imports from industries including biopharmaceuticals, robotics and rail equipment. A full list of products will be released in 15 days, according to White House officials, which will give businesses time to petition for certain items to be excluded. As mentioned, the tariffs are expected to affect 50 billion worth of goods imported from China. Certain Chinese investments into the US will also be limited. Chinese officials have said China will not sit idly to see its legitimate rights damaged and will take all necessary measures to resolutely defend its legitimate rights. Reports suggest China will impose tariffs on US exports of the major agricultural products, including sorghum, soybeans and hogs. More than half of the soybeans and sorghum exported by the US goes to China. Investors need to keep a close eye on the 10-year Treasury bond yields after the US Federal Reserve's decision to raise interest rates midweek was largely expected. The 10-year Treasury yield trades at around 2.82%, still below the key 3% level that investors are closely watching. The increased likelihood of a trade war will likely move yields higher in the medium term to longer term, which is not ideal for global markets. I guess one of the key takeaways from all of this is that with rising bond yields and rising political uncertainty, expect volatility to remain in markets into the foreseeable future. We suggest you monitor your investments closely and speak to your advisor as to the best way to position your portfolio for this increased volatility. I'll pass you over to Cam now, who will discuss his key pick for the week.
Yeah, thanks Matt. Today the stock I'll be covering is Boral Limited, ticker code BLD. Boral is an international building and construction materials company headquartered in Sydney. Boral's core businesses are cement and construction materials in Australia, plasterboards in Australia and Asia, and bricks and roof tiles in Australia and the US. This week we heard from the highly impressive CEO Mike Kane, which explained that approximately 50% of Boral's earnings are now derived offshore, which has been a drastic transition from a mere 15% only 6 years ago. Mike cited that North America and Asia are the growth markets for Boral. However, all three key markets are growing in what has been an extraordinarily long cycle. The tailwinds behind the company and further drivers of this business will be generated from contract wins based on the domestic and international infrastructure boom. The addressable market will be buoyed by Donald Trump's $200 billion infrastructure proposal, should this arise. Boral will also benefit from their recent $3.5 billion acquisition of Headwaters Inc. And Mike noted that the upswing in the US housing cycle could still see another 7 to 9 years. Domestically, Mike was bullish and cited infrastructure spending in Queensland and Victoria. However, he did temper his remarks by noting that the high costs of doing business in Australia with increased energy, land and labour costs. Boral remains a cyclical business which needs to be bought and sold with the cycle. Trading on 18 times next year, we'd look to accumulate on weakness closer to 7. Matt.
Thanks, Cam. Well, that's another wrap. Please feel free to share this video with your colleagues and friends, and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also subscribe to our YouTube channel below. Have a great weekend, and we'll see you next time.